Welcome, everyone. I am absolutely thrilled you're hanging out with us for this explainer today, because we have a seriously fantastic breakdown lined up for you. We're going to peel back the layers of a completely real-world options trading spreadsheet. Now look, if you've ever stared at a dense, intimidating block of financial data and just wondered what the actual story is behind those numbers, well, you are in exactly the right place. We're going to take some raw, focused transactions and turn them into a literal masterclass on generating yield. So grab your notes, get comfortable, and let's get right into it. Okay. Let's dive into this. $786. I mean, wow. And to be clear, this isn't some theoretical projection or a what-if hypothetical scenario. This is the actual hard total premium collected in the case study we're breaking down today. It's a solid, tangible number that really sets the foundation for the whole shebang. But you know what? The absolute dollar amount isn't actually the craziest part of this equation. It's the time frame.
Yep, you heard that right. That $786 was collected in just 27 days. Specifically, we're looking at a super tight trading window from June 22nd to July 19th, 2026. This is exactly why this case study is so fascinating to look at. It perfectly demonstrates how a really strategic, short-term options writing strategy can generate steady revenue in basically under a month. But to understand exactly how this trader pulled it off, we need to break the whole thing down step by step.
So, here is our roadmap for the explainer. First, the options case study itself. Second, we'll define free cash flow. Third, we're breaking down the actual trades. And finally, number 4, the strategy for their next moves. I promise we'll take all this dense financial data and deliver it in really logical, easy-to-follow pieces.
All right, kicking things off with Section 1, the options case study and real-world yields. And just for context, our focus today is entirely on actual trading data for the ticker symbol AL, which is American Eagle Outfitters.
And this brilliantly illustrates exactly what went down. Here's the raw transaction set for AIO over that exact 27-day period. Now, I know spreadsheets can look a bit like a giant puzzle at first glance, but if we just look closely, a really clear picture emerges. Across all these rows, we're seeing a total volume of 2,700 shares being leveraged across a mix of put and call contracts. And definitely notice that green shading. That indicates contracts that were not exercised, which is a massively important detail we'll be circling back to. This right here is the raw engine of that $786 yield. But to truly get why these specific trades were made, we have to understand the trader's underlying mindset.
Which brings us to Section 2, defining free cash flow. This is the core philosophy. We really need to define the exact goal driving every single one of these trades.
So the exact formula defining success for this trader is actually pretty straightforward. Free cash flow, or FCF, equals the premiums received, plus or minus the net replacement cost. Think of it like this. When you sell an option contract, you collect a premium right out of the gate. That's cash in your hand today. But the true profit, your real free cash flow, isn't totally finalized until that contract either expires or is closed out. Why? Because you have to account for any potential cost to replace those shares or buy back the contract later. So the crucial point is really captured in the trader's golden rule here. When contracts expire without being exercised, the FCF yield is 100%. Just think about what that actually means in practice. If you sell a put option, you collect that premium up front. If the stock just stays above your strike price, well, the option expires completely worthless to the buyer. You don't have to buy the underlying stock at all. Your replacement cost is literally zero, meaning you keep every single penny of that initial premium. That golden rule is what's steering this entire transaction set.
Moving right along to Section 3, breaking down the trades. Let's deconstruct this and look at the actual mechanics of how this yield played out over the month.
Now, what's really interesting about this slide is the specific positioning of the strike prices within these 27 contracts. You can clearly see the trader is systematically selling puts at the $17.50 strike price. And then, actually notice this, they later moved down to the $16.50 strike price as the market price fluctuated. They're actively adjusting their safety net. By carefully managing these strikes over weekly and bi-weekly expirations, the trader is just stacking small, consistent wins. Almost all of these are puts, though we do see one row with 6 call contracts sold. And again, look at all that green. Those are the contracts expiring unexercised, maximizing that 100% free cash flow we just talked about. To really put this into perspective, let's extract the vital stats from that dense spreadsheet. 27 contracts sold over 27 days. I mean, that's just beautiful symmetry right there. And of course, that generated the $786 total. But look at the bottom line, an average daily revenue of $29.11. This is the absolute so what you should take away from this. This strategy isn't about massive, high-risk bets hoping a stock rockets to the moon. Not at all. It's about being the house. It's about letting the clock work in your favor, collecting a very steady, reliable $29 a day through disciplined mechanical options selling. All right, bringing us to Section 4, Strategy for Next Moves. The 27-day run was a clear success. So how is the trader planning to manage this portfolio going forward based on current events? Well, the strategic goal right now is heavily focused on managing their capital position. They explicitly state they want to sell the next batch of AOCO contracts at that $16.50 strike price. Why? To effectively move a realized capital loss back into an unrealized status. By rolling the trade or establishing a new position at this specific level, they're actively managing their cost basis and keeping things flexible. But picking that $16.50 strike isn't just a random guess. It is highly dependent on the news of the day. And this quote perfectly bridges the gap between raw data and trading psychology. The trader writes, "I believe that current market price has been driven up by Middle East peace hopes, so I'm being very conservative." What we're seeing here is the trader acknowledging that macroeconomic and geopolitical news, specifically hopes for peace in the Middle East, can cause these temporary optimistic spikes in market prices. They're looking at this and thinking the current stock price might be artificially pumped by the headlines, rather than actual company fundamentals. So instead of chasing the juicier premiums that come with a higher strike price, they're playing it safe. Let's move to and see how this builds into their actual cued action. Because of that incredibly conservative sentiment regarding the macro environment, the trader submits this specific order. It's sitting right there, queued up and waiting to execute. Let's summarize the specifics of this new trade. Submitted in the early hours, 3:07 a.m. to be exact, they're looking to sell 7 AEO put contracts expiring on July 24th, firmly sticking to that lower, safer $16.50 strike price. They've set a strict limit price of 30 cents per share, targeting a $210 premium. Now, keeping that geopolitical context in mind, by setting this strict limit at a lower strike, the trader is basically saying they would rather completely miss the fill, just let the trade go unexecuted, than risk getting caught at a higher strike price in a market they feel is artificially inflated. Oh, and one more super important note. There's an upcoming AEO dividend on that exact same target date, July 24th, which definitely adds a whole extra layer of complexity to the pricing and assignment risk here.
And that leaves us pondering this final, really provocative question. We've just walked through the mechanics of a highly successful 27-day run generating pure free cash flow, but now the environment is shifting. Will this conservative strategy, opting for a lower strike and literally risking not getting filled amidst all this geopolitical optimism, actually pay off? Will the stock hold its value, or will those peace hopes fade, proving the trader's cautious 1650 safety net to be a totally brilliant move? It is such a fascinating look at the constant interplay between global news and mathematical trading strategies. Thank you so much for joining me to unpack this explainer today. Keep analyzing those charts, stay curious, and we'll catch you on the next one.